Welcome back to The Explainer, everyone. I am so thrilled you're here today because, well, we're going to unravel a really fascinating valuation mystery. We're putting Marriott International under the microscope. Look, whether you travel for business or you just like a good vacation, you absolutely know the name. But what you probably don't know is that right now, Marriott's financial profile is throwing up one of the most interesting puzzles in the entire market. As focused learners, I know you guys love getting straight to the facts, so we're going to use Marriott's latest financial data to see exactly how the market is pricing this hospitality giant. Basically, we want to know, is this a wildly overpriced stock, or is it an elite compounding machine that is totally worth the hefty premium? Let's figure it out together.
Okay, let's dive into this. We've got a 5-step roadmap today. First, the fair value gap. Second, the growth engine. Third, profitability and efficiency. Fourth, measuring the price tag. And finally, shareholder rewards.
All right, Section 1, the fair value gap. Let's see if this thing is actually overpriced.
So right out of the gate, there's a really glaring discrepancy we need to talk about. The stock's latest closing price out in the open market is sitting at $353.17. But when we run a standard discounted cash flow model, which, as many of you know, projects a company's future cash flows and discounts them back to what they're actually worth today, it spits out a fair value price of $292.92. That's a pretty big difference. Right now, the market is basically ignoring that intrinsic value calculation and pricing the stock roughly $60 higher than what pure cash flow models suggest it's actually worth.
And that leads us to an absolutely crucial number, a negative 20.57% margin of safety. Now, as value investors, we're usually hunting for a positive margin of safety, right? You want to buy a stock for less than its fair value to protect your downside. But here, the margin is deeply negative. Investors are willingly paying a nearly 21% premium just to own a piece of Marriott today. When you see a negative margin of safety like this, it immediately begs the question, why? What on earth is the market so optimistic about here? What is Marriott doing so exceptionally well that people literally do not care about paying a premium?
Moving to Section 2, the growth engine. Let's look at their history of massive returns. To understand that premium, we kind of have to look in the rearview mirror to see if Marriott's underlying growth actually justifies all of this market enthusiasm. And honestly, the data brilliantly illustrates exactly why investors are in love with this stock. Just look at the total return by period. Over the last year, a very solid 14.6% return. Zoom out to 5 years, and we're looking at an incredible 162%. But the 10-year number, that's where it gets truly wild. 472.81%. If you had invested in Marriott a decade ago, you'd have nearly quintupled your money. The market knows this is a proven compounder, and a track record like this builds a really powerful narrative that Marriott just wins, year in and year out.
Let's stretch that timeline out even further. A 15-year return of 1,128.46%. I mean, come on, at a certain point, these numbers start sounding like a typo, right? But it's very real. And the crazy thing is, it's not just blind speculation pushing the stock price up. The underlying business is humming. Their net income 5-year compound annual growth rate is a blistering 59.58%. They're growing their actual bottom line profits by nearly 60% a year over the last 5 years. When a company is expanding its profits that rapidly, the market is naturally going to assign a massive premium to the stock.
Up next is Section 3, Profitability and Efficiency. How well are they making the most of their assets?
Well, growing your income is really only half the battle. How well do they run the actual day-to-day business? Just look at this number, 63.15%. That is Marriott's return on equity. For every single dollar of shareholder equity in the business, Marriott's management is churning out over 63 cents in pure profit. That is an elite, staggering level of capital efficiency. It tells us that Marriott doesn't need to hoard massive amounts of capital to generate cash. Their whole franchise and management fee business model, it's incredibly asset-light and clearly incredibly lucrative.
And you see it play out across all their other efficiency metrics too. Return on assets is sitting at a very healthy 9.36, and return on invested capital is at 11.20%. Plus, they maintain a net profit margin of nearly 10%. Now, it is worth pointing out here that Marriott does operate with a very low current ratio, just 0.46. Now, normally a current ratio under 1.0 can sometimes signal some liquidity risks, but for an asset-light cash flow generating machine like Marriott, it just proves they run extraordinarily lean. They don't let cash just sit around collecting dust, they put it to work immediately.
Which brings us right to the million-dollar question. Okay, we've established that Marriott is a high-performance, hyper-efficient business with a history of just massive compounding returns. But is this elite performance actually worth that premium price tag we talked about at the very beginning?
That brings us to Section 4, measuring the price tag.
Let's dig into the multiples and ratios.
To really figure this out, we need to look closely at the specific multiples to see what investors are paying today for a slice of this pie. We'll start with the classic price-to-earnings, or PE ratio, which is sitting up at 37.06. To put that into perspective, an investor buying Marriott stock today is willing to pay over $37 for every single dollar of Marriott's earnings. In the hospitality and cyclical travel industry, a multiple in the high 30s is, well, it's objectively expensive. It suggests the market has absolutely zero doubts about Marriott's ability to dominate and grow its earnings way into the future.
Now, you might look at some of the other valuation metrics and get a little confused. For example, the price-to-book ratio is incredibly negative at -22.85, and the debt-to-equity ratio is also heavily negative at -4.04. Don't let these scare you off. A savvy long-term holder might view this as just a quirk of a complex capital structure rather than a broken business. Often, companies with massive historic share buyback programs or specific debt setups will run a negative book value. It definitely doesn't mean the company is insolvent. As we just saw, their cash generation is phenomenal. It just means traditional book value metrics are effectively useless for valuing this particular company.
Because of that capital structure quirk, we really should be looking at enterprise value multiples instead. These factor in both debt and equity for a much cleaner picture. And this brilliantly illustrates the premium valuation across the board. EV to EBITDA is at 22.06, EV to EBIT is over 25, and EV to sales is 4.05, meaning the whole enterprise is valued at over 4 times its total annual revenue. Honestly, no matter what lens you look through, Marriott is undeniably priced for absolute perfection right now.
Even when we try to give them credit for their incredible growth rate, the stock still looks expensive. Take the PEG ratio, which divides the PE ratio by the expected earnings growth rate. It's sitting at 4.28. Generally speaking, value investors look for a PEG ratio near 1.0 to indicate a fair balance between price and growth. At 4.28, the market is screaming that the price has outpaced even the most optimistic near-term growth estimates.
Let's wrap up with Section 5, Shareholder Rewards, specifically dividends and cash flow.
So the stock is historically expensive. But how exactly does Marriott treat the investors who are actually willing to pay these steep multiples? Well, they do reward their shareholders directly, but you kind of have to look deeper than just the surface yield. The current dividend yield is tiny, just 0.83%. However, look at the payout ratio. It's only 28.48%. That means they are only paying out about 28 cents of every dollar they earn as dividends, which leaves a massive cushion. They've increased this dividend for 4 consecutive years, and most impressively, the 5-year dividend compound annual growth rate is almost 25%. So sure, the yield is low today because the stock price has absolutely skyrocketed, but the actual cash they are handing back to shareholders is growing incredibly fast.
And they can easily afford to keep growing that dividend because of this final metric, a free cash flow yield of 3.04%. At the end of the day, after paying for all operations and capital expenditures, the business generates real, tangible free cash flow. A 3% yield on free cash flow gives them a very sturdy foundation to support those aggressive dividend increases and massive share buyback programs moving forward. So, that brings us to our final provocative thought for today. We've laid out the data. We've seen a business with an eye-watering negative 20% margin of safety to its intrinsic value, trading at a PE in the high 30s. But we've also seen a company growing its net income by nearly 60% a year, boasting a 15-year return of over 1,100%, and generating cash with extreme efficiency. So I leave you with this to ponder. Does the nearly 60% net income growth rate justify paying a 20% premium? Does elite quality outweigh a steep price tag? The numbers are all on the table. The true fair value is now entirely up for you to decide. Keep learning, keep analyzing, and I'll catch you guys in the next explainer.